All right, so let's begin the segment. And this segment, we're going to talk about having the right kind of financial advisors. So now we know that it's very difficult for anyone to navigate through their finances, manage their investments. You might be taking help from robo advisory, or you might be having an AI recommending you what to invest, where to invest. But having said that, can we really depend totally on robo advisory? Can we really depend on an AI to tell us what to do, what not to do? The traditional financial advisory, has it gone faded? Is it out of the trend now? Let's discuss all of this. I have Arun Kumar from Funds India with me. Arun, hi, and welcome to the show, and thank you so much for joining in. So yeah, it's a long-going debate now. Ever since we've seen robo-advisory coming in, where you just have an online platform telling you, as per the details that you fill in, you spend so much, you save so much, so you can invest so much, or maybe details like, you want so much amount of money in so many years. Robo-advisory, AI advisory, and traditional financial advisory also. What exactly is your take on it? How are you looking at it?
At a broader context, I think there's a lot of questions on will human financial advisors survive the AI onslaught and all that. Net, I think they will. I mean, obviously, I am biased because I'm coming from this side, but having dealt with a lot of clients over the last 14 years, the real challenge is not about prescribing a particular plan. The real challenge comes because it's very, very hard to stick to a plan over a 15-20 year cycle, because as we see, the markets are I mean, they go up, they go down, and today we are probably at a 10% fall in the market. But always the problem is you never know whether it is just a 10-15% fall or the start of a large fall. And there is a lot of conflicting information. Somebody says sell, somebody says this person has cash. So there is a lot more information available and a lot more confusion. And emotionally, it becomes harder and harder once the amount of money becomes larger. And which is also why you see a lot of larger wealth clients, despite the fact that despite the fact that they are paying hefty charges as a percentage of their portfolio, they still have an advisor. So overall, I believe that the real challenges would be that there is too much information, and also from an emotional behavioral point of view, it will predominantly remain a behavioral problem, because markets being markets, as long as they go up and down, you will always have that the behavioral angle to it. And as long as there is the behavioral angle, I think financial advisors will always have a vital role to play.
So Arun, exactly. Now, since you spoke about challenges, I also want to understand now, when you are talking to investors, is it a challenge to handhold them, because we're talking about long-term investing, because that's a time when you really need to stay invested, and have that trust in your investment instrument, just stay put. So is it a challenge now? How would you like to explain this to our viewers and to your clients and investors as well?
Yeah, so the way I like to think about this is that, see, the moment you say behaviorally, it's a very hard thing, it's still a vague term, right? So the way I would like to simplify this, we have a very simple framework to understand what is this whole behavior. If we remove that and talk in very laymanistic terms, we believe that, you need a basic exposure to equities, which is a bias towards equities if at all you want to build long term wealth. While you may not want to go all in on equities at 100%, but at least anything more than 60% is required in a portfolio which is trying to build wealth over a 15-20 year period. And net, the challenge of having equities is that it keeps going up and down. Up is fine, but the reality is that up also gets scary. So the way we think about it is that equity markets do three things to you. One, they scare you, they seduce you, or they slow you. So at different points in time, they do these three things to the investors. So scare you is comes in the form of four things: A, B, C, D. All-time highs. It's a very ironical thing that at all-time highs also we were worried that the markets will fall. And whenever the market falls, right, there is always a bad news, which is like every 3 months you will have something or the other. A few months back, it was a war. There was something on the Japanese yen. Today, it is FII selling. Today, it's Trump. We had COVID. We had so many things happening. So there is bad news every 3 months. And then again, there is somebody calling out for a crisis, or there is a cash call, which is the C part of it. Then that is also imbibing fear. Then the last part is the declines, right? Every time there is a 10-15% decline, you're not sure whether it is just a small decline or the start of a 50% fall, because a 50% fall will also have to start with a 10-15. So all these four items keep happening again and again. And so this creates fear. So most people take out the money, try to time it and have a bad experience. The second is how does it seduce you? The same ABCD, it makes you, it tempts you to go all in. Like suddenly people go all in on equities. They say, I don't need gold, I don't need debt, I don't need any other asset class. I'm going all in on equities. And B would be like sometimes you even borrow money and then you go even more than all in. And then the C is you concentrate your portfolio. There is something which is done well, say small caps or say sector funds, or there's a new NFO where you don't have any idea, but the story seems to be fascinating. So you tend to chase returns and you tend to concentrate your portfolio. Within equities, you are very, very risky, which is also kind of evident in the last 12 months. Almost 50% of the flows in MFs, equity MFs, have gone towards sector funds and small cap, which is technically the most riskiest part of the equity market. And then the last D is your day trading and derivatives, where you take even more risk. And then so either the market scares you or it tries to seduce you into going overboard, or let's say you survive both, then it tries to slow you. Like every time you have new money and you are trying to enter, there is this entry paralysis or entry anxiety, because you will always feel that the markets will go down, because at market all-time highs, you felt that the markets will go down 10%. At 15% fall, like few weeks back, you felt that it will go down further. Now that it's gone up, you are confused. Will it go down further? So that the fact that every time you have money, it is very, very, very hard for you to invest new money into equities. There is always that paralysis. So you put all these three things together. I think behaviorally, to handle all these three problems for a 15-20 year period is where the challenge is. And that's where I think advisors can really play a key role. And obviously, there is the portfolio construction part where you do asset allocation, where you do diversification and rebalancing. But I think that's probably a solved problem. It's like the fitness plan. Everybody knows what is a good fitness plan, but the following part is the hardest thing. So that's how I would like to think through this.
All right, Arun, on that note, last question, because since you are over here on the show, I would really like you to help our viewers, just in case if someone is looking for a career as a financial advisor, what would you recommend?
Yeah, so broadly, there are two different ways of see net. The idea is that you will have. I mean, there is a value offering that you're giving to the client. Now, how you may get paid can be through two different routes. You can go under the MFD route, where the you get commissions from the. I mean, where the client is not directly paying you, but it comes through commissions from the mutual funds directly, or you can also charge the client directly through an RAA model. Both of these are fine, but make sure your value prop and the offering is very clean. You will technically need to do three things. One, at its core, it's just three simple things, that you figure out what is the goal, or what is the purpose of the money, or what is the client requirement for which they are saving up. And two, put a plan which can connect the savings, the investment portfolio, and the goal together. And the third part is that how do you make them travel this journey over a 10-15 year cycle, because you will get hit with one very, very, very large fall, like a COVID fall or like a 2008 crisis. That's like a given. On a 10-year cycle, it's very, very fair to expect a 40-50% kind of a fall. And there will be a regular falls. There'll be a lot of market noises. So how do you make sure your client does not panic, or does not get seduced, or does not slow down his investments through the entire journey? So I think if you, this is the three parts of it. Now, different people will have different variations of how they put together their plan, how do they handle the emotions of their clients, and how do they get the requirement of what goals and how to plan for that. So once you are fairly aware of these three, I think then it's all like, I mean, there are certain exams that you do, but otherwise it's fairly a straightforward process. And then it's a long term career, because the first 5 years are very, very hard, because you will have to build trust, and mostly it is a referral based business, so it will take time. But the compounding effect starts playing out, because your clients are increasing money by, probably they're growing their savings by 10%. Your portfolios are probably growing by 10%. And if you get new clients at say 5 or 10% extra, so technically it becomes a 20-30% business over a long period of time once you set the base. So which is why becomes a fascinating business once you're there for probably 5 to 10 years. But the first 5 years are the hardest, where the money is also not lucrative enough.
All right, so that's a word coming in from Arun Kumar. Arun, thank you so much for being on the show and helping our viewers, navigate through their investment decisions and also the importance of having the right kind of financial advisor. Thank you so much for being on the show.